When people think of passive income, the first thing that comes to mind is rent from real estate. But there's another way to tap into that idea without owning or managing property yourself, through REITs. That's short for Real Estate Investment Trusts. These are publicly traded companies that invest in real estate and pass on the profits, whether from rent or property sales, directly to shareholders. And here's the kicker. By law, REITs have to distribute the majority of their earnings, usually around 90%, as dividends. That means if you hold REIT shares, you're getting regular cash payouts, almost like being a property owner, but without the headaches of tenants or management. Sounds pretty appealing, doesn't it? And the good news is, you don't have to choose individual REITs one by one. There are ETFs that bundle hundreds of these real estate companies into a single investment. In this video, we'll take a close look at the most popular REIT ETF available here in Europe. We'll compare it to a more traditional dividend ETF, steady and dependable, though not spectacular. And I'll tell you honestly what I think about this REIT ETF and whether I would personally buy it. Quick disclaimer before we dive in. This is not financial advice, just my own opinions and experiences. When I search on Just ETF for distributing real estate ETFs, I find 17 different options. The most popular among them is the HSBC FTSE EPRA NAREIT developed UCITS ETF, and that's exactly the one we'll dive into today. I believe this ETF has potential, and it's no coincidence that it's the most widely chosen. But first, a short word on the ETFs that come in at number 2 and 3. The iShares European Property Yield ETF focuses only on Europe, which means its portfolio contains fewer companies with official REIT status and more general real estate firms. The reason is simple. The REIT structure is less common in Europe than in the US. Since those non-REIT companies aren't legally required to distribute most of their profits, the overall performance suffers. Its total return, dividend size, and payout consistency are noticeably weaker compared to the HSBC ETF. Then there's the iShares Developed Markets Property Yield ETF. It tracks almost the same index as the HSBC ETF, so its total return and cash flow are nearly identical. The catch? It costs roughly double the HSBC ETF, which came out 5 years later. That's probably why the fund volume of the iShares ETF has been shrinking for years, while the HSBC ETF's volume keeps climbing. If they don't cut costs, I wouldn't be surprised if this iShares ETF disappears in a few years. All right, let's take a closer look at the HSBC ETF itself. Fund volume. This ETF's popularity has exploded in recent years, and now its fund volume stands at around 1.5 billion euros. At the end of 2022, there were massive inflows into the ETF, most likely from institutional investors. And even if we only focus on this year, since the start of 2025, the fund volume has jumped by more than 40%. That's a remarkable surge. One of the main reasons is the expectation of interest rate cuts, which makes this REIT ETF especially attractive right now. Allocation. The country allocation is dominated by the USA, with Japan, Australia, and other developed markets following behind. Emerging markets don't play a role here. The US stands out because it has a huge number of genuine REIT companies. Still, this ETF also includes property firms that don't carry official REIT status. For example, there are also German firms in the mix, but most of them are not REITs. Looking at the top 10 holdings, we see almost exclusively US companies. These are well-known REITs, active in areas like data centers, retail, healthcare, and industrial property. Even though the ETF is very US-heavy, I actually find the top 10 holdings quite solid. In total, the ETF spreads its investments across more than 300 companies, offering solid diversification. Performance. This chart shows how the ETF has developed since its launch. The green line tracks the price, while the blue line reflects the total return including dividends. The price performance on its own is rather disappointing, but the total return paints a more respectable picture. What really stands out is that dividends account for nearly half of that total return. So, at first glance, this makes the ETF look like a reasonably worthwhile investment. We'll come back to its performance later, when we compare it directly with a dividend ETF. Cash flow. Let's move on to dividends. Payouts come in January, April, July, and October, which I personally find very convenient, since those months are rarely covered by dividend ETFs. Since its launch, the fund has delivered an average dividend yield of 3.1%. Let's be honest, that's weak. From solid real estate companies that are required to distribute almost all of their profits to shareholders, I would have expected much more. What I do like, however, is the stability and reliability of the payments. There's even a slight upward trend in dividend growth. For a REIT ETF, that's actually quite solid, because such consistency is far from guaranteed. To give you some context, let's look at the payouts of the iShares European Property Yield. The payouts look inconsistent, and there's no visible trend of dividend growth. And on top of that, its average dividend yield is even lower than the HSBC ETF. So overall, this ETF doesn't look bad at first glance, but the real question is, why should anyone buy it? Why invest in a REIT ETF at all? Usually, there are two reasons. Investors hope for less volatility compared to a classic dividend ETF, and they expect higher dividends. So let's put the HSBC REIT ETF side by side with a traditional dividend ETF. For example, the SPDR S&P Global Dividend Aristocrats UCITS ETF. The SPDR isn't a high flyer, but it's a modest and steady dividend payer. Looking at performance, we've got a neat comparison chart that goes back more than 10 years. And here's the surprise. Even though the SPDR's total return of around 5% per year is modest, it still comes out clearly ahead. Meanwhile, the HSBC ETF has been struggling ever since interest rates started climbing in 2022. Take 2020 as another example. We all remember how the pandemic shook global markets. And what happened? The REIT ETF dropped just as hard as the regular dividend ETF. So the idea that real estate investments are somehow more stable is simply a myth. Investors often forget one crucial point. Shares of real estate companies are still shares. Why should they be less volatile in a crisis? In reality, they crash just like the rest of the market, sometimes even harder, because ultimately, this is a sector bet. Speaking of sectors, if we compare the two ETFs, the HSBC fund is entirely focused on real estate stocks. The SPDR, on the other hand, includes property companies, but also the classic dividend-paying sectors like finance, utilities, and industry. So why limit yourself to real estate when you can have the whole mix? Well, maybe the REIT ETF at least delivers better dividends? I'm afraid not. We've already seen that its yields aren't exactly impressive. Here's the comparison. The SPDR's dividends are not only more stable, they're also 25 to 30% higher than those of the HSBC ETF. Is this comparison with the SPDR unfair? I don't think so. I deliberately chose a modest, rather boring, globally diversified ETF. I could have compared HSBC with the Van Eck Morningstar Developed Markets Dividend Leaders ETF instead. In that case, the performance chart would look even worse for HSBC, and both dividend levels and growth would be clearly stronger on the Van Eck side. At the beginning, I promised I'd tell you whether I would invest in this REIT ETF or not. And if you've watched the last few minutes of this video, you probably already have a good idea of my answer. Let me stress again, this is just my personal opinion. I don't claim to know it all, and everyone should make their own decisions. That being said, the ETF may be popular, but I honestly don't see a convincing reason to invest in it. This REIT ETF gives you about the same volatility, but with lower dividends and poorer returns than a simple dividend ETF. With a real estate-focused ETF, you're basically making a sector bet. And if I'm going to make a sector bet, I'd much rather go with tech. What really disappoints me here is the cash flow. Well, maybe with individual REIT stocks you can squeeze out a decent dividend, but not with this ETF. If it were 5, 6, or even 7%, I might consider it. But at 3%? No thanks. Do you own REIT stocks or REIT ETFs yourself? And if so, why? I'd really love to hear your thoughts, so drop a comment below. That's it for today. See you next time.